Live. Good afternoon, everyone, and welcome to the Preparing for Due Diligence webinar, a founder's checklist. This webinar is hosted by Angeles Investors, and our mission is to find, fund, and fuel the most promising startups, while at the same time equipping our members with frameworks and discipline to evaluate opportunities. My name is Francisco Mariscal, and I am the investor at Angeles Ventures. First, before that we start the conversation, let's introduce our panelists. First, we have Martha Mercogliano, founder and CEO of Mercogliano Advisors. And Martha, please briefly introduce yourself, a little bit about your background, what you do at Mercogliano Advisors, and your first approach to due diligence.
Thank you, Francisco. Like you said, I founded this company. I'm the CEO of Mercogliano Advisors, and what I do is I help founders who are trying to bring their solutions into the larger healthcare ecosystem. And it is we have a very complex healthcare system in the U.S., as you all know. And a lot of times our solutions that are developed, that the founders develop, are amazing, and they are going to make a very big change. That they're going to disrupt healthcare, but it's very hard to get it implemented into the larger system. So I help them with how do we connect with the other parts of the system. My specialty is government programs, Medicaid, Medicare, and also commercial insurance. So basically, I help them get paid. So that's what I do. And I have 25 years of experience in healthcare. I worked for a very large healthcare payer, and that's where my experience comes from. And I have always been very, I've always loved innovation. So that's what called me back to do this again and work with founders.
That's cool. Impressive background, Martha. Your background and your experience will add a lot of value to this conversation. And next, I would like to invite Domingo Guerra. He's the managing partner at Chispa VC. And please, Domingo, if you can share a little bit more about your background, what you do at Chispa VC, and your first thoughts about what a due diligence process looks like.
Thank you, Francisco. So I've been in Silicon Valley for about 20 years, first as an engineer, then as a founder. I started a company called Authority in the mobile security space in 2011, and then sold it to Symantec in 2018. So I lived the diligence side first as a founder, trying to get fundraising done. We bootstrapped for a few years, then did Series A, Series B. And then through the acquisition, that was a different kind of diligence as well from an acquirer, what they look for and how to prepare for that. Starting 2018 onward, I got to be very active as an angel investor, done about 45 investments as an angel. And then last year, we launched Chispa as an early stage cybersecurity venture capital firm. We help founders get to market faster and try to accelerate their sales from pre-seed or seed up to Series A. For me, due diligence is trying to always obviously get to know a team, their approach, their capabilities, where they are now, but also try to see where they will have to be in different milestones of their growth, because most companies require funding in multiple rounds, and how to time those rounds and be prepared to meet those milestones is a very important part of the diligence. And the other key objective for me in doing diligence is to try to standardize it in a way so that it's more measurable and repeatable. If I have a bad day as a person, as an investor, if I'm not feeling well or if I'm in a bad mood, I don't want to rank a team lower than I would if on a day that I'm in a good mood, right? So I want to have a process that is repeatable and that helps me evaluate startups over time, so that it's not just a snapshot each single day, different type of point of view, but try to have a more even way of measuring.
That's incredible. It makes a ton of sense. And I know that you have a special framework of when thinking about due diligence. I don't know if you want to take a time to explain it and what are the main components of it.
Yeah, absolutely. So in trying to standardize, the vision was I need to be able to rank and measure startups with a framework, and anyone else on our team that helps review should use the same framework as well. And the test for a good framework is if multiple people look at the same company and you end up having the same or very similar scores. The framework also helps you get emotion out of it. And just because you really like a founder or you really like a mission of a company, you won't rank them better than you would otherwise. So for the framework, I actually used David Olivencia's podcast. He mentioned about time and what time means for investors, spending time with founders, and then measuring the team, I, innovation, M, market, and E, energy or execution. And I took that idea as a seed and ran with it and tried to come up with a more kind of, being an engineer, more of a mathematical framework. So for T, for me, is the most important. And I divided T into team, traction, and TAM, the total available market, with 20% each. I is other investors in the round, as well as the innovation. M is marketing, moats, how defensible it might be, at 15% of the score. And then E, energy and execution of the team and the founders at 10% of the score. So it gave me just a high level math framework that then I can drill down and add more details so that the scoring would be one, repeatable, and two, scalable as we start looking at more and more companies.
Yeah, I think it's key for general partners to have a framework and always rely on those framework and try to put numbers to those frameworks as well, so you can compare in an even way. But to start this conversation, I want to frame it first. Due diligence, at least when I was a founder, is often misunderstood. Many founders think that due diligence starts after the term sheet, but no. In reality, it starts much like before, and you need to prepare for it. And from an investor perspective, as Domingo said, due diligence is about reducing uncertainty, to know what problems the startup may have, and to decide if you want to take those risks. So, as an agenda, I want to cover in this conversation five main pillars. One is financials and unit economics, what an investor is expecting in those terms, cap table and governance. Third, customer traction and retention. Fourth, legal and intellectual property hygiene. And finish with the team and execution risk. So, with that, let's start the conversation with the financials and unit economics. And here I want to make a distinction. I know that Martha comes from the health tech space, and Domingo comes from the cybersecurity space. So we'll have different lenses. Martha, from your experience, what are the most common financial gaps you see when companies enter the due diligence?
Thank you, Francisco. I think that one of the biggest uh, gaps that I see is a founder doesn't have enough experience in where the decisions, the financial decisions, are being made in healthcare. We have a very, very complex healthcare system, and the simplest way that the solutions a lot of times come to us that we see is a direct to consumer solution, and that's great, that's easy. But when you want to grow your slice of the pie, and you want to start involving larger piece of that demographics, you need to start thinking about who is going to pay for the solution that you're bringing. It's one thing to think who's going to be using the solution, and another one is who's going to be paying for the solution. In healthcare, they may not be the same entity or the same group of people. Sometimes it's even more different. It even gets worse because it's one group that uses it. It's another group that actually pays for it, and it's another group that authorizes it. So you need to be very very aware of all these different stakeholders that need to be at the table, because if you don't, you might be pandering, working with one group and not aware of the others, and then you might be thinking that your market is huge and your unit economics are going to be amazing, and they might not be as good.
So basically, understand the revenue streams
Yeah.
underlying the unit economics. Domingo, do you agree? Do you see any red flags when you analyze the financial economics or unit financials and unit economics of startups?
Yeah, and right now a big trend is obviously the use of AI, and a lot of founders are heavily relying on other products, maybe OpenAI or Anthropic or Gemini in the back end. Uh, these companies right now are at a big arms race. So the price per API call, the price per running some of the AI models is maybe lower than it should be if there wasn't that fierce of a competition. And one of the worries I have when a founder has or a company has very little margin on top of their AI use. So say you're selling your product for $100 a month and you're spending $95 a month or $90 a month on the back end, is that any price change from that very critical piece of your infrastructure will make you not profitable at all, right? So trying to not have the right margins in place or relying too much on a third party can be a huge red flag. And then to echo what Martha mentioned, a lot of times the founders focus so much on their user, which is great. It's important to get feedback from whoever's using the product, but without understanding who the buyer or who signs the check and what their priorities might be. And a lot of times inside the enterprise, there's conflicting budget where maybe your competitor is not just the people that make a similar product, but your competitor is everyone that's fighting for that same budget. And if the budget is shared resource between maybe the technology team like the CTO, the or CIO, and the security team like the CISO, then you better have a good map of what the other departments are spending money this year and where their budgets are, and make sure that there's enough budget for your product as well.
Interesting, because you touched upon the same thing about the revenue stream and who is the decision making in that revenue stream. And to your red flag, Domingo, I agreed. When I ask founders about their unit economics, sometimes they don't know it, and if they know it, maybe they don't have the vision about the future, about how that will move. So that's very
Yeah.
important.
And on that point, Francisco, early sales are usually early adopters, where maybe they found you, or there were connections that the founder and the early team already had. So early unit economics might not have a real measure of a customer acquisition cost of what it means to go out to the wild and find brand new customers from zero through first meeting, through proof of concept, through closing. A lot of times those numbers are not there in the early stage, and founders can underestimate the cost it's going to take to grow their business.
100%. 100%. And
If
then
I may,
continue,
sorry,
Martha.
it's Domingo, that you're so right about that. It's like the low hanging fruit, right? You absolutely have to go after those customers first. But when you run out of those, then what is the real customer acquisition cost?
What's a sales engine? And then if you compare that lifetime value of your customer with the real CAC, with the real cost of acquisition.
Yep.
So I think we touched upon the financials and unit economics and how founders need to be prepared before the first conversation. And so let's move to the second topic about cap table, governance, and structure. Martha, what are you looking to analyze when you see a cap table? What are the main mistakes that founders they do when they structure their ownership?
Well, we all prefer cap tables that are simple and clear, right? And that preferably fit in one page. if there's too many stacked saves and investments, it starts getting difficult to manage all the governance basically. And the problem with that is that it slows down it slows down the decisions. And maybe today you won't see it as much, but down the road, a badly managed cap table is going to impact further fundraising rounds. It might impact your Series A, or when you have a pricing round, it might impact how that round, the feasibility of the round. So that's something that I'm try to be aware of. And if it's a messy cap table, you want to talk to the founders about it. It might not be a make or break question, but it's one of the first things that, because it shows that hasn't been a good discipline for fundraising, right? They have fundraised and just been adding fundraising rounds to that cap table. It doesn't show a very strategic fundraising.
Domingo, I don't know if you can add some color, and especially when founders they ask like, should I raise with safe convertible note or just direct Sometimes they want to raise through common shares, and I say like, no, venture capital they prefer preferred stocks. So, what is
Mhm.
your opinion there?
Yeah, I think the SAFE is a wonderful instrument that's very founder friendly and then easy to understand by VCs. So certainly it's better than what we had before, where every round had to be a price round, or convertible notes could be sometimes very aggressive on the interest, which again was tough on the early startup. So I love safes, but to Martha's point, if there's no minimum to what an investor can get on the cap table, it creates other problems. So imagine for M&A or for a Series A, and you need to get signatures from everyone on the cap table. It's much easier with 3 to 5 folks on the cap table than 50 folks on the cap table, and you have to go get signatures from everyone. Now, besides safes, I've seen SPVs, or special purpose vehicle, as a very clean way to pull maybe a lot of smaller angels together, so that on the cap table it's just one entry, and then you can have more folks participate. So people want to get their friends and family involved. I wouldn't just let them be on the cap table unless it's a larger check, just to keep the cap table clean. The other risk as well of fundraising maybe too much too early, is when the founders and the team don't have enough equity going forward. So as a pre-seed or seed investor, if I see that the company already lost 30, 40, 50% of their shares before they even get to Series A, it's a huge red flag, because there's not going to be enough incentive for those founders to go with a long, painful life of building a startup for many, many years. Up30, it took us about a decade from starting through exit and the earnout. So you got to be able to keep the founders motivated, the team motivated, and that means they have to have enough skin in the game, enough equity. So I also look for bad terms or predatory investors that might have come in as a big red flag. And I think the last red flag, which can be maybe a blessing in disguise sometimes, is sometimes founders get really excited when they get a big name VC come in very early on for like a pre-seed, but the VC doesn't give them a partner. They give them maybe an analyst that did the deal, and then later the founders get surprised that the big VC doesn't give them a lot of time for help. They don't schedule any board meetings. There's no board seat. There's no back and forth with the investor. And then if the founder didn't execute at a very high level, that big firm doesn't come in on the next round, which then is a red flag for everyone else trying to invest in that next round. So again, it's difficult to say no to a check, as a founder that has to had good bootstrapping, and then fundraising is difficult. But whenever possible, a founder should try to get the best investors possible, not just the name of the investor or the name of the firm, but the ones that are going to be able to add value at that stage and help them get to that next stage, the the best way.
Yeah, I agree that it's very tactical. The what you want to show, and you have to prepare that from the first time that you start fundraising. For example, what's your optimal dilution between one round and the other one? I like to see 20%, but I don't know your
Mhm.
thoughts, Domingo.
Yeah, I think 20% is pretty normal now. Perhaps on the median side or average side, and obviously teams with more traction or more experience often end up getting less than 20% dilution per round.
That makes sense. That's are the same numbers that I'm seeing. Martha, anything to add?
No, I was just actually thinking on the medtech side, that the dilution actually ends up being worse, and that's because of time, right? Going back to what you were saying about time, Domingo, and when you have to do an FDA submission, and those takes a lot of time. So a smart founder will find ways to survive during the time that they get that approval, and either creating pilots or some other ways to get revenue while the final product gets the approval. And that works really well in some cases. Sometimes you're not just can't do that, you know.
Yeah, and in fact, that touches in the next section about customer traction and commercial validation. So let's move there. And I want to ask you, Martha, what are the main metrics that you focus when you do the due diligence? It's pure traction, revenue, customers. What do you like to see?
I like to see. It depends a lot of the type of the type of solution that they have. But for example, if they are if it's something that if it's a solution that they're working on with that is like a back-end solution, let's say a voice agent. If it's a voice agent, what I want to see is pilots that they have with different health systems or providers. You know, depending that it doesn't have to be a lot of pilots, but if those pilots are converting, that to me is a clear indication that it's a product that is being successful. You know, an LOI or a pilot that it didn't go anywhere, it might be a red flag, actually.
I also like to see, Martha, just right there, the pipeline. I like to ask about the pipeline and then monitor if the pipeline is converting or not. I don't know, Domingo, if you also request in your due diligence process the pipeline, and what do you like to see there?
Yeah, especially from pre-seed to seed, I think you start looking at early signs of maturity, where we've seen a big shift in the market with AI. I think pre-AI and post-AI startups look very different. But pre-AI, it was normal for pre-seed to be pre-product and pre-revenue. And now pre-seed, because folks can code with agents, you don't need a big team. You don't need to fundraise to start building a prototype and getting feedback. So even if you don't have sales, at least you have something where you can show early customers, get some feedback, get some design partners. And I see that as very valuable traction. Whether or not you have sales yet, I think the pre-seed building something and getting feedback is more important than ever. And then from that perspective too, getting pipeline is the ability to find new opportunities, not just the folks that you already knew. For example, we spoke about that earlier, but what early signs are there that this is a big enough problem that you're able to at least get meetings and get folks interested in learning about your product? Because if you're building something and nobody cares to meet with you, that's a pretty scary signal. And maybe meaning that you shouldn't be raising too much money or building too much product until you fix the interest side and find something that's going to have better chance of finding product market fit.
Yes, I agree. And to that point, what I always ask is about the metrics of usage or engagement with the platform, because that will show me if customers are really using the platform, are engaging with the pilot, or they have it simple there because of their relationship with the founder.
Yeah, absolutely. I call it the weekend test. If someone turns off the product on Friday and nobody notices on Monday, then you're not really a product that's going to get renewed at the next renewal cycle.
I like that. I like that. Okay, so
Something else. I'm sorry. There's something else that I wanted to add. You made me think of this. Is well, I love the weekend test. I love that one. But I was thinking of even with early startups, I have seen that they have come up with multiple revenue avenues, and this is amazing that even at an early stage, they're already thinking, well, I can there's this side of the market that I can go for, and then I can also move this product in this other way. And so the different that allows them to work more, put more of their effort in one or another. And if one of them starts slowing down, then the other revenue avenue might get better. And I'm thinking about this for like the voice agents option, or a device that might might need an FDA approval, but while you get the FDA approval, you can go, you can use pilots, you can use other options to get you through, even grants or something to get you runway until you get that approval. So those additional revenue avenues are really important.
Yeah, and to prove, continue, Domingo.
Yeah, I just remembered there's one more kind of customer traction metric they had never seen before, but now it's pretty common, and that's kind of revenue or ARR per employee. Again, we think about the last kind of investment big cycle 2020s where we had a big bubble. Folks could raise money on just an idea, and it was grow at any cost. It doesn't matter whether you make revenue or not, you'll figure it out later. And I think that died after the last crash. And surviving COVID meant for a lot of companies be very, very lean and don't spend any money and just survive. And I think now we're in the new era where growth is important again, but it's responsible growth. And gone are the days when you can just keep raising money without showing proper traction between rounds. So we need to be able to show that you're growing at an efficient rate. A responsible growth is important. And I think now, for the first time ever, we see 1, 2, 3-person teams that are starting to get revenue. And again, that's because of AI. So that revenue per employee metric is kind of a good measure to see how efficient companies are growing. It's a newer metric. I mean, normally you never saw that at a startup, but now the fact that it's possible, it's just remarkable, and it really clearly shows the line between the pre-AI startups and the post-AI startups, where you can get a team of 3 to 5 engineers build an amazing product that would have taken them 10, 20, 25 engineers before. So that new company is way more efficient with their growth, getting to revenue with just a small team. It's a much safer investment.
I completely agree with you. In fact, the AI will only accelerate the trends and the development time. So, something to think about. Let's move to the next section about legal, IP, and operational hygiene. And here I want to start with Martha, given that she's in the health tech space and there is a lot of legalities and intellectual property and FDA approval. So, Martha, if you can share a little bit about what you like to see in the legal diligence of health tech startups.
Yeah, thank you. Highly regulated space, healthcare. So it's one of the first things that come to mind, right? And some of the things are table stakes, but you still have to ask because you never know. HIPAA, you need to be compliant with HIPAA. When you're raising a round, by the time that you're raising a round, you need to have already considered HIPAA and have it in the, you already need to be HIPAA compliant, or at least know that with the money that you're raising, that's the first step that you're going to take. There's other things that you need to be compliant with, SOC 2 and all kinds of other things, but that's the main one. And data privacy. There's all kinds of things that we could, I'm not going to get into all of them, but about data privacy and AI LLMs training on your personal data, and all those are very important that you as a founder know that you need to be aware of how you're treating the data, and then that you're transparent about it. It's not necessarily a bad thing. I have some founders who are actually training their LLM models on patients' data, but it has been sanitized, so it's not it's de-identified. And I have other founders who are very, very careful that their LLM, and they actually, this is a selling point, they ensure that everyone knows that their LLMs are not being trained on the patient's data. So those, you just need to know which one is your strategy and which one you're going to follow. And then just one other thing about IP, patents. Patents in when you're filing for FDA is critical, and it takes a lot of time. So you have to protect your intellectual property and make sure that you spend time on planning to have that done, because you're going to need the right attorney and all that process to, so you do it right, and you don't have somebody come in and just feel that and skip ahead of you.
That's patent. It's a very interesting topic, Domingo. I don't know if you can elaborate on that and what, like, if you are pro patents, what do you think about them, if they're necessary in the due diligence or not?
Yeah, I think anytime you have something that can be considered an unfair advantage is important. I think patents or intellectual property definitely fall there. It's defensible. Obviously, as a startup, you're not going to go around suing people because it's really expensive, but it helps from a defensive perspective, and at least shows that whatever you're working on is novel. If a patent a clerk at the U.S. Patent Office reviewed it and approved it, even if it's just patent pending, it shows a higher level of technical moat than a company that doesn't have it. And then to Martha's point on the compliance certification, whether it's HIPAA, uh, ISO 27001, right? Selling into the enterprise, again, for cybersecurity, for us, we see that also as very important. If you're selling to an SMB, maybe less important, but if you're selling to a bank, to a large enterprise, to the government, to healthcare companies, you have to go through all those compliance checkpoints. And again, the earlier a company can start the process, some of these take a long time. Just the path that you are FedRAMP ready or in progress can show, one, that the team is on top of things, and two, it gives a lot of confidence to your customers that you are going to be able to meet the high bar that these large companies will place on a company. I always love when founders tackle the large companies first. Might be easier to get to revenue or logos by going to the SMB first, but it's very difficult to go from SMB ready to enterprise ready. It's much easier to go from enterprise ready to SMB ready. So you can always grow downhill, to use that analogy, but you can't go in the reverse direction necessarily.
Interesting, interesting. Uh, Also, like the time to market, it's a little bit different. But if you have the right founding team, I think that makes a difference, and that gives me the path to the next section and the last section before Q&A. It's about, at least for me, the final confidence question is if I am confident of the founding team, if I think that that is the right founding team. And my question to Marta: what is for you a founder product market fit, or founder fit with the problem that he's solving? What it
Yeah.
takes?
Yeah, thank you. And that's a really great question, Francisco. I think that finding that it's a matter of pattern recognition. You know, it's if you the founder needs to have the right experience with either with the problem or the solution that they're trying to solve, because are they creating a solution that is better than the alternative, and how do they know? You know, where is that authority coming from? Where is that from? Experience, from from lived experience, from having worked in the industry, and Ivy League is nice, but doesn't always help. It's more about what experience do they have in the area that they're creating, and also sometimes it's the founder, sometimes it's a team, and if it's a team, I want to see complementary skills so that that team can work and perform and execute really well.
I love that, like the complementarity of the team. I don't know, Domingo, if you agree.
Yeah, absolutely. I think, especially knowing as a founder before, it's very tough, right? There's a lot of risk of founder burnout. And if you don't have a strong team that you can rely on, it's going to be even tougher. And if you can't recruit a team, if you can't convince top people in their fields to come in and join you, it's going to be very difficult as well. And that's one of the other big traits I look for founders. Yeah, like Martha mentioned, ability to execute and domain expertise can be huge advantage. But I'd say like storytelling and communication can also be big game changers. Storytelling, if we think about it, what it is, it's the ability to communicate with different audiences, levels of sophistication or not in the problem, and then relate the problem and solution to them in a way they're going to understand. That's obviously going to help with fundraising at every stage. That's going to help with sales at every stage. That's going to help with recruiting and being able to sell the vision that the founders have for the company, and why people should leave maybe a higher paying job to join them and build a startup. And it's going to help them with press and media and getting some exposure for the company in the long run. So not all of the founding team has to be a great speaker, but at least someone should be able to be the voice of that company, and really be able to drive that vision forward.
I agree, and especially the CEO has to be able to pass that vision, and as you said, not only to the investors but also to the team and to the stakeholders, the customers. It's very difficult the first sales of a startup that the counterpart does not know if you will be alive the next year or 2 years from now. So that vision and that it's very important. So we have 5 minutes. Let me go through some Q&A questions that we have in the chat. Thank you for all the people that are listening here and are putting your question. I have a very interesting question about the revenue paths. So, and I think it's for Domingo because no, maybe for Martha, because Martha, you mentioned multiple revenue paths in a startup. And the question of your first angel is: I have seen focuses leap with multiple revenues paths. How do you judge when a second channel is a smart diversification versus a distraction that slows product market fit?
Do you want to take it first, Domingo?
Sure. I mean, I think very early sales, and I was guilty of this too as a first time founder. I would sell to anyone that would take a meeting, and it felt great to get revenue, but we weren't learning really what the market was demanding, and it ended up being a distraction. So I'd say like there are some risks of different revenue paths if they're not complementary, but later there were also some non-standard revenue paths that were very helpful. And for example, we had two very large customers that asked us for features that were not part of the product. And we said, yeah, great, we'll build it for you. It'll take later. And they said, hey, if we pay extra, can we skip the line? And it's like, yeah, absolutely. So we did an NRE, a non-recurring engineering fee, 250 grand per customer. And we got two of these. So without any dilution, without any funding from other customers, we got $500,000 to build a feature we were going to build anyway. And that's a type of revenue that's non-standard. You can't count it as sales. It's not renewable revenue, but it is aligned with your product and your vision and your direction. It just helps accelerate that. So I'd say, yeah, there are types of revenue that are going to be net positives, and then there's types of revenue that could be a distraction.
I love that, Domingo. That was a great example. I love that. And what I was gonna just add is that it is a tight line, that you have to walk as a founder, so that you don't get distracted, but you are also still aware that there's other revenue streams, because especially early on, you still have to you might still have to pivot, and if you're doing things right and receiving feedback, you might need to pivot at times. And some of the greatest unicorns out there, actually, we saw them as a result of a pivot. So having different revenue streams is a way to ensure that if you need to pivot, there's a place that you need to turn to. But yes, it could be distracting. So it's a tight line that you have to walk
on. I agree 100%. If it's complementary revenue, you should do it. If it's a completely different revenue line or company, you should focus and continue building. And then there's another question about demos. How important is a product demo as part of your due diligence process? And any difference between software demo and hardware demo? And what do you want to see from that demo? I don't know, Martha or Domingo, if you want to take that question.
Sure, I'll take that first. I think if it's sometimes it's critical, right? You need to see something so that you know what the here we talked earlier. Domingo mentioned the storytelling skills of the CEO, and that is incredibly important for the CEO to be able to share the vision that he has or she has. But then there's what I look for, and for me it's a red flag, is that vision that the CEO is sharing. Is that aligned with the execution? And for me, the demo a lot of times will help to see if the CEO is saying we're gonna help make everyone healthy in America, and then the demo is more of a commercial, just trying to sell something. Is it aligned with the vision? So that's why the demo to me is really important. It tells me that there's alignment with those between the vision and the execution. So yes, I think it's important.
I love seeing demos as well. It's part of the storytelling. It shows me how well the founder understands a potential customer. So I try to wear a customer hat when I'm seeing the demo and try to ask questions that way. That said, there is also a trap. And some founders get so excited with the demo that that's all they want to do during a meeting, that they should be talking about customer acquisition and sales and metrics and other aspects that are important to me as an investor. And remember that I'm not a customer, so I don't need to see just the demo. And I think that can be one of the traps sometimes, is that they overly rely on the demo and look at the product and look at all the features, and we do this and we do that, and I didn't have enough time to learn about them, their team, their market, and their ability to execute.
And the business.
Yeah.
Finally, I'm investing in a business, and investors they need exits. So, and I think we have 1 or 2 minutes, so I want to start wrapping it up. Uh, One, thank you, Martha, and thank you, Domingo, for this conversation. If can ask the last question about if you have any recommendations for founders that are passing from an initial MVP to the due diligence process. What do you recommend to those founders? Maybe let's start with, I don't know, Marta or Domingo, whoever you want to take it.
What I would say is that take the opportunity of going through due diligence process with an investor, to take feedback, and because that is the best way to learn what you can improve. Due diligence is kind of like the final test, right? That's where you will see where you are not doing great in some areas, and that's where you can go back and work on those. So don't think of it as a don't take it personal. Take it as feedback and go back and work on it from the feedback that you get.
I love the lean startup process.
Okay.
Anything to add,
And
Domingo?
I would be proactive too. So before the investor asks for it, say, hey, here's our data room. Even if it's just a Google Doc or a Google folder with links and presentations, one customer testimonial, something, just build it over time. The more you have, the more prepared you'll be for a tougher diligence later. And it also gives you the ability to see where investors are spending their time. If you have a data room, you're able to see, oh, they opened the presentation, or they didn't even look at any file. It gives you a chance to do diligence on your investors as well.
Would you give the ability to download the files or not, Domingo?
I
Would you?
do. I love being able to download files. Some folks get really scared about downloading files, but if you don't trust your investors to download a file, you shouldn't trust them to invest in your company.
I agree with you, but that was a very tactical question that I had when I was a founder, so that's why I wanted to ask it. Okay, I want to conclude this session first saying thank you to Martha and Domingo. Thank you all for joining. I really enjoyed the conversation, and I hope that right now you understand a little bit better what it means to be diligence ready, whether you're raising capital or evaluating the next investment as an angel investor. So, on behalf of Angeles Investors and Angeles Ventures, thank you again for joining us, and we look forward to see you in the next session. Thank you all.
Right? Thank you.